Markets move because money moves, and money moves for a reason. Follow the money. For decades, South Korea built some of the most powerful companies in the world. Companies that changed how people live, how people communicate, and how technology moves forward. Samsung became one of the most important names in global electronics. SK Hynix became a critical player in the semiconductor industry. Hyundai transformed from a local manufacturer into a global automotive company. Korean companies built ships, produced batteries, created smartphones, and became essential suppliers for the modern economy. But there was something unusual about this success story. The companies were successful. The economy was advanced. The technology was world-class. Yet the stock market often remained undervalued. For many global investors, Korea was a market full of great companies. But not always a market where capital wanted to stay. This created a strange contradiction. South Korea became one of the world's largest economies, but its stock market valuation remained below many other developed markets. A country known for innovation was often priced as if investors were still uncertain. This gap became known as the Korea discount. A simple idea. Korean companies were often worth less in the market than their global competitors. Not because they lacked technology, not because they lacked talent, but because investors questioned something deeper. Could Korean companies truly create value for shareholders? For years, the answer was complicated. Many Korean corporations were controlled by powerful family-owned business groups, known as chaebols. These companies helped transform South Korea from a developing economy into a global industrial power. But the same structure that created growth also created concerns. Investors questioned transparency. They questioned corporate governance. They questioned whether minority shareholders had enough influence. And they questioned whether profits would always benefit all shareholders equally. For international investors, this was not just a question about individual companies. It was a question about the entire market. Could Korea become a place where global capital felt comfortable staying for decades? Or would investors continue looking elsewhere? For a long time, the answer remained uncertain. But now, something is changing. Global money is starting to look at Korea differently. Not because Korea suddenly became powerful. It already was. The change is that investors are beginning to believe the market itself may be changing. And when the rules of a market begin to change, capital begins to move. For many years, global investors asked the same question. Why are Korean companies so successful, but Korean stocks often trade at lower valuations? This difference became known as the Korea discount. The idea is simple. Two companies can have similar businesses, similar technology, similar profits, but investors may value them differently. Because markets do not only price what a company earns today, they also price how confident investors are about the future. And for decades, confidence was the challenge. One of the biggest reasons was Korea's unique corporate structure, the chaebol system. The word chaebol refers to large family-controlled business groups. These groups played an enormous role in Korea's economic transformation. After the Korean War, South Korea was one of the poorest countries in the world. Through decades of industrial development, these companies helped build one of Asia's most advanced economies. They created global brands, They expanded overseas, and they turned Korea into a technology powerhouse. But success also created complexity. Many cable groups developed complicated ownership structures, a network of companies, cross-shareholdings, and controlling shareholders for founders and families. This structure provided stability. For some investors, it created concerns. They questioned whether decisions were always made with all shareholders in mind, especially minority shareholders. A global investor buying a Korean stock was not only asking, "Is this company profitable?" They were also asking, "Will shareholders receive a fair share of that success?" This question became especially important because Korean companies often accumulated large amounts of cash. But compared with companies in other developed markets, many returned less capital to shareholders. Lower dividends, fewer share buybacks, and sometimes limited communication with international investors. Over time, this created a pattern. Strong businesses, strong exports, strong technology, but weaker market confidence. And confidence matters, because stock markets are not only places where companies raise money, they are places where investors decide which companies deserve higher valuations. A company with high confidence can receive a premium. A company with uncertainty can remain discounted. This is why the Korea discount lasted for so long. It was not caused by one single problem. It was a combination of factors: corporate governance, shareholder returns, ownership structures, and investor trust. But markets are never permanent. The same forces that created a discount can also create an opportunity. When a country begins changing the way companies operate, global investors start asking a different question. Not, "Why was Korea cheap?" but, "Could Korea finally become more valuable?" And that question is why capital is starting to move back. For years, the Korea discount looked like a permanent feature of the market, a problem too deeply connected to corporate culture, ownership structures, and investor expectations. But markets change when incentives change. And recently, South Korea began attempting something unusual. Instead of only trying to attract more investors, the country started looking inward. The question became, how can Korean companies become more valuable to the shareholders who already own them? This idea became known as the Corporate Value Up Program. The goal was simple: encourage companies to think differently about value creation. Not only growth, but returns. Not only expansion, but efficiency. Not only building larger businesses, but rewarding shareholders. For global investors, this was an important shift, because valuation is not only about what a company produces, it is also about how the company treats capital. A company can generate billions in profits, but if investors believe those profits will not return to shareholders, the market may assign a lower value. This is why measures such as higher dividends, share buybacks, better corporate governance, and clearer communication can have a major impact. They change the relationship between companies and investors. Think about it this way. A factory creates products. A technology company creates innovation. But a public company also creates something else: trust. And trust determines how much investors are willing to pay for future growth. This is the reason many analysts compare Korea's situation with Japan's market transformation. For decades, Japanese companies were also criticized for holding too much cash and providing limited returns to shareholders. But after corporate governance reforms and changing investor expectations, Japan became a market that attracted renewed global attention. Korea is now facing a similar question. Can it create a new relationship between companies and shareholders? The answer is not guaranteed. Changing a market that developed over decades does not happen overnight. Corporate structures are complex. Investor confidence takes time to rebuild, and reforms must move beyond announcements. They must appear in actual decisions. Higher returns, better transparency, more shareholder-focused policies. These are the signals global investors are watching, because capital does not move only because governments make promises. Capital moves when investors believe the system itself is changing. And that is the real test for Korea. Not whether it can create great companies. It already has. The question is whether those companies can finally become great investments. For years, investors viewed Korea as a manufacturing powerhouse, a country built on exports, ships, cars, electronics. But the next wave of global investment is focused on something different. Artificial intelligence and AI has changed where capital wants to go. Because behind every artificial intelligence system, there is physical infrastructure, data centers, advanced chips, memory, and enormous amounts of computing power. This is where Korea suddenly became impossible to ignore. For decades, semiconductor memory was one of Korea's greatest industries. Companies like Samsung Electronics and SK Hynix became global leaders. But the AI boom created a new demand. Not just more chips, but more advanced chips, especially high bandwidth memory, known as HBM. HBM became one of the most important components in the AI hardware supply chain. Modern AI models require enormous amounts of data. The faster that data can move, the more efficiently AI systems can operate. And this created a new investment opportunity. Companies that were once viewed as traditional semiconductor manufacturers became critical players in the future of artificial intelligence. SK Hynix became one of the companies most closely associated with the AI memory boom. Its relationship with the global AI ecosystem, especially advanced GPU supply chains, made investors pay closer attention. Samsung, with its enormous semiconductor capabilities, also remained a key company in the global technology race. For international investors, this changed the story. Korea was no longer only a market with discounted companies. It became a market connected to one of the biggest technological transformations in modern history. This is how capital moves. It does not always move because a country changes overnight. Sometimes it moves because the world changes and a country's existing strengths suddenly become more valuable. The same factories, the same engineers, the same technology expertise can be valued differently. When the global environment changes, this happened before. Energy companies became more valuable. When energy prices changed, defense companies became more important. During geopolitical uncertainty, and now, semiconductor companies have become central to the AI revolution. But there's an important difference. AI is not only a technology story, it is also a supply chain story. And global investors are constantly asking, who controls the critical parts of the next generation economy? For artificial intelligence, Korea has become one of those answers. The money moving into Korea is not simply a bet on Korean stocks. It is a bet on a changing global economy. And as AI continues expanding, the world is looking differently at the companies that make AI possible. When global investors move capital, they are rarely looking at one country in isolation. They compare, they measure, they decide where the next opportunity may exist. And today, Asia has become one of the most important regions in global capital allocation. But each Asian market tells a different story. Japan represents transformation. After decades of low growth, Japan began pushing companies toward better governance, higher shareholder returns, and more efficient use of capital. India represents expansion, a growing population, a growing economy, and a long-term growth story that attracts investors searching for scale. Taiwan represents technology leadership, especially in advanced semiconductor manufacturing. Its position in the global chip industry makes it one of the most strategically important markets in the world. And Korea represents something different, a combination of existing industrial strength and potential revaluation. Korea is not a new economy story. It already has global companies. It already has advanced technology. It already has a highly skilled workforce. The question is whether the market value of those strengths can finally catch up. This is why global investors are paying closer attention. They are not simply asking, can Korea create successful companies? The answer is already clear. Korea has done that. The bigger question is, can Korea become a market where success is rewarded? That distinction matters. Because capital does not only follow growth, it follows opportunity. And opportunity often appears when reality changes faster than investor expectations. For years, many investors saw Korea through the same old lens. A mature economy, a complicated corporate structure, a market with persistent discounts. But markets are based on expectations. When expectations change, valuations can change. This is the process investors call multiple expansion. A company can become more valuable, not only because earnings increase, but because investors become willing to pay more for those earnings. And this is the possibility behind Korea's current story. Not that Korea suddenly became better, but that global investors may finally recognize the value that was already there. Of course, there are still risks. Corporate reform takes time. Geopolitical uncertainty remains. Competition in technology is intense, and no market moves in one direction forever. But capital does not need certainty to move. It only needs a reason. And right now, Korea has several reasons that did not exist before. A changing corporate environment, a leading role in artificial intelligence, and a market valuation that still leaves room for potential change. This is why global money is watching Korea. Not because the story is finished, but because the story may just be beginning. For decades, South Korea's market story was defined by a contradiction. A country that built global companies, but struggled to receive global valuations. A country that created technology, but did not always create investor confidence. A country that became essential to the global economy, while its stock market remained underestimated. That was the Korea discount. But markets do not remain unchanged forever. The same factors that once created uncertainty can become the foundation for a new opportunity. Corporate reform, higher shareholder returns, artificial intelligence, semiconductor leadership. These forces are changing how investors look at Korea. But the future is not guaranteed. Markets do not reward countries because of potential alone. They reward execution. A company does not become more valuable because investors hope it will change. It becomes more valuable when change appears in real decisions. Higher returns to shareholders, better corporate governance, stronger communication, more efficient use of capital. These are the signals that global investors are watching, because capital is always searching for the same thing. Not only growth, not only innovation, but confidence. Confidence that the future will be better than the present. This is why Korea matters. The story is not simply about the Korean stock market. It is about how markets reprice opportunity. For years, investors looked at Korea and saw problems. Now, some investors are beginning to see possibilities. The difference is not the country itself. The difference is the way the world values it. And that is how capital moves. Slowly, quietly, before most people notice. The biggest changes in markets often begin not with a headline, but with a shift in perception. Korea's next chapter will depend on whether companies can transform potential into lasting value. Because in the end, great markets are not created only by great companies. They are created when companies and investors believe in the same future. And right now, global money is asking a new question. Not, can Korea build world-class companies? It already has. The question is, can Korea finally become a market that the world values accordingly? That answer will decide the next chapter.